Welcome to the Tricord Advisors podcast. This is where we answer your questions to help you get excited about your finances. This is Randy Barkley, and I'm Jeremiah Lee. We're both certified financial planners, and I'm also a California licensed attorney.
You know, this has been an interesting time. I'm glad that I've lived long enough to kind of see these intervals. And going back to 2008, there was the crash of the real estate market and the government's intervention, I guess is the best way to say that, but the amount of money that was put in. Mm-hmm. And anything that had a growth component to it took off. And we had almost 10 years of uninterrupted growth. And for those stocks in particular that we didn't worry about a dividend. They just went, right?
Yep. Today we're talking about, looking back at the last 10 years and looking forward to the next 10 years.
Yes.
And we, a few weeks ago, we talked about 1 year. What's going to happen this next year? 2023, what are we expecting? Today we're talking about the last decade and how that informs us for the next decade. I'm excited about this one. And just like you said, from 2008, 2009, we had the financial crisis, and then things turned. Mm-hmm. And we had a period where we had low inflation. We had low interest rates, rock bottom. We had the government stepping in, having this quantitative easing. And so anything that had some semblance of growth, anything that was going to get bigger in the future.
You could utilize low-cost money.
Yeah, you could borrow. Yeah,
you could borrow at, you're talking about these large mega cap companies, they could borrow at below 2%, and it was better than taking money out of the bank. So they just used that borrowing capacity phenomenally.
To grow. And a good example of this, I think, is Tesla. They're one that early on, they were not paying dividends.
Right.
They were not, they didn't have a functional value in the sense that you could look at their P&L, their profit and loss statement, and say, this is what they're worth. But the world was their oyster. The future is bright, and they had this access to cheap capital to build and to build and to build. And so because of that, stocks like that, they've been done phenomenally over the last 10 years. And part of what we'll talk more about, part of what we're seeing is that this has changed.
Yeah,
I feel like we're at an inflection point.
I really do believe it's an inflection point. As much as 2008 was an inflection point moving forward, I think right now where we're at right now is an inflection point.
Yeah.
And the inflection point means that we've got rising interest rates. The money supply is shrinking. So hence it puts more pressure on established companies to pay dividends. Those look more attractive than a growth company that needs to borrow money. I think, we don't get in the technical side of it, but growth companies are going to come under pressure.
Yep.
And we've seen that since the beginning of 21 because growth stocks have really retreated from their highs, but value companies have maintained themselves pretty much through 22, and going into 23, they've continued to be in that framework.
Yeah, and part of what we're saying here is that we're going to see, the whole market is going to move up and down. The whole market is going to do certain things. But in the last decade, if you bought a passive index,
you just bought the five top, or you bought a fund that emphasized that, right?
Yeah.
The five stocks, the FANG. You would almost to 5 times. It would gone up almost 5.5 times over a 10-year period.
Yeah.
So $10,000 would turn into almost $55,000.
Right, and that's a phenomenal investment. So say something that was not trading, not making deals, just a passive, maybe like an index that was on U.S. growth mega cap, buying just the biggest growth tech. That would have been looking back, that would have been the best play for the last 10 years. And a lot of people did that. There's a lot of people who are in these S&P 500 mega cap indexes, and that's been really great. And what we see is that looks like it's come to an end. To say if this next decade going forward, if that's what you held, you'll get return. Absolutely.
And there's a lot of reasons for this. Obviously, inflation is a big factor, and the Federal Reserve is fighting against inflation, and interest rates are going up. But also the money supply, the quantitative easing is not filling everybody's bucket, so to speak.
Yeah, and people may not know when we talk about quantitative easing, the money supply. The money supply is how much money is out there to be spent.
Right.
And there are all sorts of great charts that track this and show this. And it's incredible to see that during this last decade, we have been, in essence, printing money.
Right.
But we've been creating more money, and the government's been pushing this money out, most recently in stimulus, but even before that in quantitative easing, there's just more money out there. And if there's more money out there, it's fueling things, whereas we've reached now a point where the money curve, as you watch it, it was going up, and it's plateaued, and now it's starting to come down, meaning the government's trying to pull some money back to say, there doesn't need to be so much available money to everyone. They're raising interest rates, they're pulling back money, they're trying to slow things down. And companies that are really solid, they are great companies, they make a good product, and they're just what we consider investing wise a dividend.
Well,
They're
we
pumping out
categorize
dividends.
them as value-based companies, right? So we look at the value-based. There's a whole sector on large cap value, and those companies kind of come out of that, and you take a look at them. We don't want to get in mentioning all the different companies and such, because we could spend here all day analyzing individual companies. But companies, in essence, that pay dividends and historically have paid dividends, they were not the beneficiary from 2008 up until 2021, the end of 21. The large cap growth companies were the beneficiary of the economy. Now, all of a sudden, it's a pivot.
Yep.
And we've seen that. And we started that back in early 21, and it's carried forward into right now.
Yep. And a big piece of that pivot, which, let's talk through, is that last decade, we had globalization was a big deal. People are sending their factories overseas. We had the just-in-time supply chains where a piece of steel goes from one country to another just in time to make it into a widget, just in time to ship it to another country to get it finished. That was what everyone was doing, and the growth seemed amazing. Great. Well, part of this pivot is, we talked about inflation, we talked about volatility, talking about a little bit about the globalization. We are starting to see regionalization, to say we don't want, because of the issues we run into those last few years, having these supply chains, people want their supplier to be kind of down the road. And there's a big discussion about Mexico, the US, and Canada.
In fact, where's Biden right now? He was in Mexico.
Oh, was he? Yeah,
he was with the president of Mexico, as well as Trudeau from Canada, and they're talking about the three countries in the cooperation, and of course the center of all that is the United States. But regionalization is coming back.
Yep.
So they want to bring it back closer to the use.
Some of those factories, just give an example. If there's a factory in the U.S. that moved to China over the last decade, say. That one may not move back to the U.S. That may not be what happens, but it might move to Mexico. It might move to Canada. It might move to the U.S. But we're anticipating that things like that will be moving to Mexico, to where they're further away, or they're closer, but they're still within labor markets that are useful. And there's one of the folks in the article we read. There's some different stocks. There's a railroad stock that was his favorite, because he was saying it's the only railroad provider that connects Canada, the U.S., and Mexico in a system. And he was just saying his idea is that in the future of this regionalization, that railroad company is going to be moving stuff. They don't have to get on big freight.
They don't have to send things across the ocean.
Yeah, they don't need to use the ocean, just go straight. So that was a big part of the last decade. This next decade can be regionalization. We talk about value stocks. Bonds are another interesting one. Bonds have been miserable recently.
Yeah, I mean, last year they got hammered, and I think that's one of the big pivots, is that there was clearly a change regarding the value of a bond and the purpose of a bond going forward. Now, with that said, bonds actually have a pretty good return. If you look back historically, what we've seen over the last 10 years, that's a big change too. Because a bond over the last 10 years, you got maybe 0.5%, 1/4%. Banks didn't want your money. People said, well, I got $1 million deposit. I got $500,000. And they were getting what I call insulting interest for their money in the bank.
Yeah.
Now it's a different story, isn't it?
Yeah, it very much is. And, there's a lot of places that are now paying 4%, and 4% isn't usually what people aim for. But to say the most stable part, usually it's stable, the stable part of your portfolio is getting 4%, that gives you the freedom to have these other sides. And the question still remains for us and for many people, will bonds be the ballast? Will they be protective? And I think the answer is probably no. We shouldn't be looking to bonds to even out and de-risk a portfolio, other than just diversification. It's diversifying.
Yeah, a lot of conversation, and we're reading a lot of articles regarding the 60-40. It's just the most common.
That's a portfolio of 60% equities, 40% bonds.
And it really has not performed well, particularly over the last few years. We were suspicious of bonds over 2 years ago, and we started to de-risk or delist them from our portfolio structures, and we started to shrink because we were very concerned about it. We thought bonds, in fact, I remember talking to clients back in 2020 and 2021. I said, bonds are the riskiest asset in the portfolio. And I said, we have to figure out what we're going to do with them. And it came to true. It was a truism by the time that we went into 2022.
Yep. So the question then for everyone is, what do we do going forward? And bonds, I think last week we spoke about annuities. Bonds and annuities were not that attractive, right? But they are becoming more attractive. And I think there's a reasonable place for them in the portfolio. I don't see that we're going to move back to, 60-40, here we go. But the idea that we have equity for growth, we have equities for dividends, We use a duration mindset, thinking about some dividend paying stocks. I think that's really useful. But we also have some bonds in there, and where and how, that's to be decided portfolio by portfolio. But they're interesting again. So I think as we're looking forward, value-based stocks, bonds, a big thing I see is not these. We used to be just the index. Buy all the FANG stocks. Buy passive, buy everything, and you'll be fine. That was great over the last decade. The next decade, I don't see that just buying the index and buying the big group is going to be the biggest home run.
We have to be very selective about the kind of assets we select, because if you select just an index is going to sweep up all the passive holdings, all the growth stocks, and it's going to throw them into that index. So you have to be very careful about either the choice of the index or an actively managed, or you select individual stocks, because I think this next 10 years is going to be completely different on the outcome than what we've seen over the last 10 years.
There's a good article we read with Burton Malkiel. He is the person who kind of ran Vanguard. He started Vanguard, he got it going, and he's been on their board for years and decades. And he's
an author of a book called A Random Walk Down Wall Street, and it's very well read. In fact, it's coming out with the updated publication here very soon for the newest edition.
Great. As a Princeton professor, he's has a great career, and he basically pushed on this index idea to say this is what everyone needs, is these low cost, passively managed index. And over the last decade, he's been entirely right. That was a great way to do it. He still agrees with his thesis of saying this is still great going into the future, and there's absolutely places for it. But as we're reading through things and thinking about things, the next 10 years may not be as useful for someone taking a passive index, someone who's going to pick some winners and losers and do it well. This may be the 10 years where we see a value in that.
Right.
And a lot of our investing, we have multiple ways that we invest. Some of it is passive, some of it is
depends on the risk model of the profile of the client, their age, their circumstances. Somebody who's 25 is going to take a different investment approach than somebody who's 65, right?
Right. And in this next decade, it'll be interesting looking back to kind of see who does best. But looking forward, it appears it will. So this has been a conversation of the last decade to kind of give us context and inform the next decade. The second part of our show, we're going to talk about what do you do? What do you do now, looking at your next 10 years, as far as investing, as well as other things? What do you do just to set yourself up for success? So come on back. We'll keep talking about this in a few more minutes. If you missed any part of this episode, you can catch us on YouTube, or you can go to our website, retirementunlimited.com.